To the Wealth Academy educational series. I'm Adam Khoo, and in this session I'll be talking about the 4 keys to profitable investing. So if you want to achieve consistent profits investing in the stock market, you have to listen to this tutorial. So let's get started. What are the 4 keys? Well, the first key is knowing, of course, what to buy as an investor. So obviously we only want to buy very good businesses, because when you're buying a stock, you're buying part of the business, all right? And this is based on fundamental analysis. Through fundamental analysis, studying the company's profit and loss statements and balance sheets, you know which are the really good companies that are going to grow in the medium to long term. Now, that only takes up 20% of your eventual success, because 10% comes from knowing not just what to buy, but knowing how much to buy. How many shares do you buy? So how many shares you buy should not be dependent on your emotions or your mood or your guesswork, but it's based on mathematical calculation, based on risk management and position sizing, which I'll talk about in a short while. 30% of your success comes from knowing when to buy. So when do we want to buy? We only want to buy when the price is going to move up right now. We do not want to buy the stock and have the stock go sideways for months and years and waste our time, right? So knowing when the price is going to go up is based on technical analysis, reading chart patterns to know the emotions of the market. Now, this takes up about 60% of your success, but a whopping 40% comes from knowing when to sell. That's the most important thing as an investor. So again, we want to sell when the price reverses into a downtrend. We want to exit and lock in our profits. Now, the mistake many investors make is they focus all their time and energy on only the first key. They always ask for tips. Hey, what should I buy? What stock's good to buy? But again, knowing what to buy is not good enough, because you can buy the right stock, the right company at the wrong time and end up losing money, or end up breaking even for many years. And that's really stupid, because as a good investor, you should be making money every single year. So let's take a look at the first step, knowing what to buy. So again, we only want to buy shares of fundamentally very good companies that are going to grow in value. And we look at criteria. For example, the company should have a history of consistently increasing sales revenue, net profits, and cash flow from operations. The company should have insiders or directors accumulating shares. You want the price to be below the intrinsic value or near the intrinsic value. So you're buying the company at a price that is of value. Next, we only want to buy companies with a sustainable competitive advantage, with a strong business model that will ensure it continues to raise its profit and sales in the medium to long term. We only want to invest in companies with double-digit growth potential. And finally, companies with a conservative debt structure. So these are criteria that make a company a good investment. So take a look at this example over here of 2 companies, General Motors and Johnson & Johnson. Now you can see that for General Motors, the green line represents its earnings or net profit. And over a period of time, the earnings are inconsistent. For example, this year, the company made a lot of money, great year. The next year, profits collapsed and recovered, went sideways, and the company lost money. Now that's really inconsistent profits, and you do not want to invest in these companies, all right? What you want is a company like Johnson & Johnson over here, where over that same period of time, whether it's a recession or not, the profits grow consistently, all right? Because when you invest in a consistent company, the share price will tend to increase consistently over time. But with companies with erratic earnings, the share price tends to fall over time. So let's now go to the second key, knowing when to buy. So when to buy is again 30% of your success. And we only want to buy a stock when the price is below the intrinsic value of the company. That means what the company is really worth. And you can calculate intrinsic value in many ways. We teach in our programs using discounted cash flow or PEG ratio, all right? But more importantly, we only want to buy when the price is on a clear uptrend. Because when the price is on an uptrend, we know statistically the price has a high probability of moving up right now. And obviously, we never want to buy on a downtrend, because if you buy on a downtrend, the probability is that prices will keep going lower and lower. For example, if you look at UOB, you can see during this period, the intrinsic value is about $20. So you know that this company is worth $20 per share. That's the intrinsic value, right? Now, because of some temporary bad news and recession, the price fell to $17. So it's undervalued, it's underpriced. Now, many people say, hey, it's a good company, it's cheap, I'm going to buy it. But remember, never buy on a downtrend, because on a downtrend, cheap can get cheaper, right? So it doesn't make sense. It's stupid to buy something and have it go down in price. So you never want to buy on a downtrend. Always wait for the trend to reverse into an uptrend. In my previous videos, I talked about using moving averages as a way to identify the trend. So remember, when the 50 moving average blue line is below the 150 moving average green line, it's a downtrend. And you never want to buy on a downtrend. You always want to wait for the 50 to cross above the 150 to signal an uptrend, and that is the moment you enter. Because the moment you enter on an uptrend, there's a high chance the price is going to go up immediately. So imagine if you bought it over here at $14, within a year, you're up 42%. But if you bought it at $17 over here on a downtrend, after 1 year, you just broke even. And that's really stupid. You're wasting your time. You only want to buy and make money right now, not next year, not 2 years from now, but right now you want to make money.